The S&P in 2024 had a fairly strong performance, up 25%, but when we take a look at some of the valuations on a forward P basis, they are looking very, very high. So today we're looking at 4 stocks with massive growth. Each one we're talking around 50% just over the next year. And the first one we're covering is Micron Technology. Now they design and manufacture memory and storage solutions, including DRAM SSDs for use in computers, mobile devices, data centers, as well as other industries. Now when we take a look at their performance, over the last year they are up only around 2%. Over the last 10 years, however, they're up a lot stronger, 155%, and we can see a massive pullback from their 52-week high at $158, right now trading towards their 52-week low. Now we get a double buy rating from Seeking Alpha and Wall Street, in fact 4.46, not far off the 4.5 to turn this into a strong buy. They do pay a dividend of 0.52% and the forward P looking very cheap at below 13, and we will explain why that does look to be cheap. Now in terms of their earnings, we love to see green right across the board. In fact, the last 4 quarters they've outperformed management estimates, 100% track record, and moving forwards the next 4 quarters, massive growth to the EPS anticipated, and if you believe management and their forecast, well, over the next full accounting period, the earnings per share at 11.53 will in turn lower the forward P to 7.7, looking incredibly attractive. Now we're going to also look at some of the gradings. First one, valuation, they get an A. The one we will draw your attention to is the P on a non-GAAP basis, 12.8. When you compare that to the sector median at 25, that means right now it is trading at a 50% discount. That is absolutely incredible, and what an opportunity. Has the market overreacted? Well, this is one thing that we do need to consider, but pretty much the majority of valuation metrics you do look at does conclude that MU is trading at a discount. Now we do notice their growth is an A+, so a little bit strange as to why they're trading at a discount, 70% year on year versus the sector median of 4.5. Forward looking as well, 42%, sector median at 5.6, and their EBITDA growth, in fact, forward looking and on a year on year basis, triple digits versus the low single digit of the sector median, and the one that we always like to discuss, the earnings per share over the next 3 to 5 years, 37% year on year, with the sector median significantly lower at 15.6. Now it doesn't stop there, because when we look at the profitability, they also get an A+. Now they do lack in terms of the gross margin, 31%, sector at 51%, but when we look at their bottom line, 13.3, a lot better than the sector median at 3.8, and we can also see the cash this company generates from operations, 10.4 billion, with the sector median at 98 million. So looking very good. As we said, double buy rating, in fact A valuation, A+ growth, and A+ profitability, and therefore we do come to the conclusion that this does look to be very cheap. In fact, when we run it through our valuation process, that is the same conclusion that is reinforced. Now what we typically do on this channel, we run through how we got to our valuation. Very quickly, we will show you for Micron Technology, as it is the first one. We have the DCF model with the free cash flow year on year. Average growth, again, it does sometimes get skewed as it goes from negative to positive a number of years. Forward looking, we've gone 15%. As you can see, we have a low, medium, and high. With the medium rate and the discount rate at 8%, we get the present value of future free cash flows and terminal value, add together with the cash, subtract total debt, get to the equity value, divide by the shares outstanding, $138, and as we can see here, 55% upside. Now remember, these numbers are subjective, and you can grab a copy of this model by clicking on the pinned comment below, writing through your own numbers, whether it's for MU or any others. Full transparency though, at the 10% point, we can in fact see $100, giving 12% upside, and for those that are a lot more bullish, 20% moving forwards, as we can see 188, that indicates more than a double, 112% from today's trading value. As we said though, we'll take the medium rate of 15%, and when we do run it through our margin of safety, something we do for every single company, we always start off 10%, execute on that if it meets the 3 golden criteria: wide moat, strong financial metrics, good forward-looking data. If you believe that today will buy at $124, then we keep going till it's near the current trading price. And what we can see in today's episode of Micron Technology, you are getting a very large MOS, in fact 35% up to around $90, with Wall Street themselves very bullish. As we said, nearly a strong buy rating, $137 price target, 55% upside over the next 12 months. Definitely one to consider if you haven't got exposure to semiconductors, but also on the other hand, you could consider semiconductor ETFs, SMH, SOXQ, and many others just to get exposure right across the board. But as always, as we have seen, the S&P 500 does look a little bit inflated, and therefore it may be better to consider individual stocks that look severely undervalued like MU. We then move on to the next cheap stock, which is Advanced Micro Devices. Now they design, produce high performance processors, graphic cards, semiconductor solutions for computers, gaming, data centers, as well as embedded systems. And when we take a look, down 14% over the last year. Over the last 10 years, massive outperformance, up 4,500%, and very similar to Micron Technology, trading significantly lower than the 52-week high at $227, and again at its 52-week low. We also notice a double buy from Seeking Alpha and Wall Street. Similarly, Wall Street not far off the strong buy rating. Now they don't currently pay a dividend, and we will run through the forward P now. As we can see, in terms of their earnings over the next 4 quarters, they are estimating double-digit growth to every single one, and over the last 4, at a bare minimum, they have been in line with management's estimates. Now, December 2025, this is what we would say is their forward P. With a $5.10 estimate, that forward P will in turn lower to 24.5. And right now, that doesn't look too bad. As we said, many in this sector and across the S&P are trading at some very high valuations, particularly in comparison to their 5-year averages. Then when we take a look at some of their gradings, the valuation at a C-. Now the P on a non-GAAP, as we just mentioned, we do believe it to be more around the 25 mark, which would put it pretty much in line with the sector overall. But again, depending on which valuation metric you use, you could get to a slightly different conclusion. In terms of the growth, well, they get an A. Marginal outperformance in terms of the top line, 10% versus the sector's 4.5. Moving forwards, 11.3, sector at 5.5. But one thing we really like about this company, as well as Micron Technology, the earnings per share over the next 3 to 5 years is expected to grow at a massive growth in comparison to the sector, which does sit at the 15.6. In terms of profitability, they do get a B+. Now, gross margin, not far off, 52 versus 51. Bottom line, 7.5, so it's slightly better than the sector at 3.8. But also the cash from operations, we are talking about the billions, 2.12, with the sector median at 98 million. And as we said, a double buy rating, Wall Street similarly not far off the strong buy, C- on valuation, A on growth, with a B+ on profitability. In terms of the valuation, well, straight away you can see upside of 50%, and again, similar to Micron, our intrinsic value pretty much in line with Wall Street and their forecast, and similarly a very large MOS, as when we do take a look and run through the numbers, we can see you are getting pretty much 35% at $123. So both Micron Technology and Advanced Micro Devices, lots of upside into 2025 and a very nice MOS. As always though, do give us your thoughts below. Some people will prefer a larger margin of safety. In fact, some people will have already started buying around the 20 to 25% mark. Now we also want to let you know we have released our latest free weekly article where we cover 2 stocks to really consider after the drop we saw last week. Now, as we drop one every single Monday morning to your inbox for free, a new copy is coming tomorrow, so do click below, sign up. As we said, we talk about severely undervalued stocks as well as what's gone in the market over the last few days, and you can grab a copy of undervalued stocks for the month of December. We're dropping January's copy over the next few days. Lots of information for each one, the upside that Wall Street themselves see over the next year, and on top of that, you can grab a spreadsheet of 29 stocks that Wall Street themselves believe have the most upside right now in the S&P 500. So click below, sign up, and you can start reading straight away. We then move on to Rio Tinto, which is a global mining company that extracts and processes minerals including iron ore, copper, aluminium, and diamonds for use in various industries. And when we take a look at this company, again, similarly trading at its 52-week low, down 21% over the last year. Bear in mind, this is a cyclical industry. As we said, we want to be buying companies when they are towards the bottom of the cycle, riding them right up. Over the last 10 years, up only around 29%. One of the things that does draw dividend investors to this company is the very high yield of 7.4%, and as we can see, the forward P sitting low at 8.5. We get our first strong buy today at Wall Street, 4.83, Seeking Alpha also considering this company as a buy. And when we take a look at their earnings, well, what we do notice is over the next full year, we are expecting a fairly small drop, but that in turn will only increase the forward P very marginally, and we can also see the revenue, only a marginal increase is anticipated to their top line. Then we get to their valuation where they get an A. In terms of comparing it to the sector, 8.5 versus 15.8. Right now, this is at a 46% discount and something that is pretty much mirrored in the majority of different valuation metrics. In terms of growth, probably no surprises. They don't get a great score here at an F. Year on year, 3.3%. Better than the sector, which was -1. Moving forwards, a drop is anticipated of 1.5%, with the sector pretty much flat. And when we do take a look at the earnings per share over the longer term, it is estimated to decrease, with the sector overall increasing at 10.9. In terms of the profitability, an A+, gross margin 31%, a little bit higher than the sector at 29%. Their bottom line 20%, a lot better than the sector median at 4.9%. And we can also see a lot of cash generated from operations, 15.24 billion, the sector comparative 407 million. So we get the one strong buy from Wall Street, a buy from Seeking Alpha, A on valuation, F on growth, with an A+ on profitability. In terms of our valuation, well, we get to $80 in terms of the intrinsic value, and again, a nice margin of safety. At 20%, a buy at $64, but at today's value, we see a 25% MOS. Bear in mind, not much growth is anticipated. You are getting a high yield, but also the fact that Wall Street themselves see a lot of upside may be reassuring. $86 over the next year. They see 46%, and as we said, 25% MOS. Do give us your thoughts in the comments below. We then move on to Fomento Mexicano, which is a Mexican multinational company primarily involved in retail, logistics, beverage industries, including operating convenience stores, gas stations, and managing beverage productions as well as distributions. In terms of this company, well, again, trading at its 52-week low, down 33% over the last year. Over the last 10 years, pretty much flat, but remember, will depend at which point you did buy. If we look around 2020, it was trading around $53, and we also notice all-time highs around $142. Also, a fairly attractive yield at just below 5%, a forward P sitting around 17, and again, we get a double buy rating from Seeking Alpha as well as Wall Street. In terms of the expectations, well, only one of the next 4 quarters are looking at growth year on year to the EPS, and when we do look back, there was a 75% record in terms of historical forecasting accuracy and a marginal increase anticipated from 2024 to 2025, which will in turn very marginally lower the forward P to 16.9. In terms of their valuation, they get a B. P on a non-GAAP basis, 17, pretty much in line with the sector median, and again, depending on which valuation metric you use, the conclusion will be fairly similar. In terms of the growth, well, a B-, 14% year on year, sector median at 1.85. Revenue forward looking a little bit higher, 4.7 with the sector at 2.5, and we do also notice that earnings per share on a diluted basis, 13.3 over the next 12 months, estimated sector median a lot lower at 6.2. Profitability looking good, B+, 41% gross margin, sector at 36%. Bottom line, 3%, a little bit lower than the sector at 4.1%. And the cash from operations looking good, 2.8 billion, a lot higher than the sector comparative at 888 million. Double buy from Seeking Alpha and Wall Street, a B on valuation, B- on growth, with a B+ on profitability. And as we said, every company, very strong upside. This one is no different, 48% over the next year. Price target, $130. And when we do run it through the MOS calculation in today's episode, we can see quite a large number, 30% around the $87 mark, 48% upside over the next 12 months. So 4 companies today that look very cheap, lots of upside, a nice margin of safety, definitely ones to consider in the portfolio. We had quite a wide range of stocks, some that paid a dividend, some that didn't, some with very high yields. But as always, give us your thoughts in the comments below, whether you're considering any of these in the portfolio, maybe you've recently added, or for whatever reason they don't fit your overall investment thesis. Don't forget to sign up to the free weekly newsletter. We are dropping a copy tomorrow morning. Grab those spreadsheets and come and join us in the Patreon where we do talk about our weekly buys and sells. As always, have a great day. We'll see you all on the next one.